Hi, I'll be illustrating the decisions that investors make when losing and making money. So, for example, we have a series of classes of assets. So, this is class A, class B, class C. And in class A, we have Tesla, there is Apple, there is Microsoft, there is Amazon. In class B, there is bonds, there is debentures, there is treasury bills and commercial papers. Class C, there is a crypto, there is bitcoins and NFTs. Just so you know, the class A, class B, class C are all financial instruments that gives the rise in economic inflow or economic outflow. That's money. So all these three assets are owned by the investor. So if, for instance, the propensity, or let me say the probability of an investor to get a gain in class A assets is 5%, and the propensity and the probability to lose money is 10%, whereas the propensity to lose money is 5%, and the propensity to make money is 20% for the class B. Class C, the propensity to make money is 10%, and the propensity to lose money is 20%. So the combination of all these percentages, this is return, this is also return, this is also return, where this is risk, where this is risk, where this is risk. So the total sum of return, the total returns is the 5% plus the 20% plus the 10% equals 35%, and the total risk is 10% plus 5% plus 20%. Hypothetically, this 35%. So the sum of risks and return for the portfolio is 0%. This means you are losing 0% and you are gaining 0%, ideally. So looking at the various factors that could affect these percentages, you could have the market speculation, the investor sentiment, the economic imbalances. You could also have some other political situations that could affect the gains and the losses from this investment. So All these factors could give rise in up and the downward shift and the upward shift of an investor's return or risk. So the main, or let me say the key reasons that investors do take is the key reasons are: one, you buy when it is low, and you sell when it is high. The buy and sell of this financial securities, like the buy and sell of this classes of assets, would determine what's going to the investor's pocket. So when you buy an asset when it's very low, with a future expectation that there's going to be a growth, like a positive growth in that stock or in the company, you tend to gain money. But when you buy it and you are not sure that you're going to gain money and eventually you lose money, that means the investor is going to lose a certain amount of money depending on whatever the investor is holding. So the classes of assets, which are Tesla, Apple, Microsoft, Amazon, bonds, debentures, treasury bills, commercial paper, cryptocurrencies, bitcoins, NFTs, and the likes, could be bought when they are very low and you sell them when it's high. You sell when it's high and you buy when it's low. That's the key decisions that investors make. And the reason behind buying when it's low is when the stock, let me give you another example. When the stock is undervalued, when the stock is undervalued in the market. So what is the meaning of undervalue of a stock? When a stock is being undervalued, the undervalue of a stock means the current market price is lower than the intrinsic value, the current market price. So if Tesla current market price is currently $400, okay, and the intrinsic value is 500. This is, let me just say CP to be current price, and the intrinsic value is 500. The difference is 100. So that means Tesla stock is undervalued by $100. That means the Tesla stock is undervalued by $100. By $100. So there are quite some potentials of buying stocks when they are very low. So having Tesla to be very low, having Tesla stock to be very low at $400 is a plus for prospective investors who want to buy very low and sell when it's high. You sell when it's high when the economic situation is benefiting Tesla shares, or when Tesla revenue is increasing. Definitely the earnings will be increasing, the dividends as well will also be increasing. So in order not to bore you too much about what's undervalued means or overvalued, the undervalued simply is undervalued stock simply means the current market price lower than the intrinsic value. So when you have intrinsic value of 500 and you have current price of 400. That means Tesla stock is undervalued by $100. That is the meaning. So investor can buy this amount. So if Tesla stock, if Tesla stock, this is the opposite now. If Tesla stocks is overvalued, that means the current price, this means that the current price is greater than the intrinsic value. So if the current price is 500 and the intrinsic value is 300, that means the original worth of a stock means the intrinsic value after undergoing some fundamental analysis. We're not going deep into that, but when the current price exceeds the intrinsic value, it means that this stock is overvalued by $200. Definitely, you can't buy this because it's overvalued. You rather buy when it's low and sell when it's high. So, overvalued stocks perform higher than its peers because they could be high growth companies, high demanded companies such as Apple, Microsoft, Amazon, and as well Tesla. Okay, so a good investor will never buy Tesla when it's high because it's overpriced. You buy Tesla when it's low because it's underpriced. Thank you.